Hey everyone, Michael here. So in this video, we're going to have a look at PayPal, and I'll walk through the company report and share with you the insights I'm gaining, and then at the very end, I'll basically share with you what my next steps would be in terms of what I would research further. So if you don't want to watch all that, that's totally fine. I'll share with you the insights that I've gained from reading the report right now, and so that'll save you hopefully a fair bit of time. So reading through this report, became obvious that PayPal is a potentially undervalued stock based on simply Wall Street's estimate of fair value, and that's obviously based off a few assumptions. So if that takes your interest, you might want to go down to the valuation section and see what the inputs are into the model, and then make your own assumptions based on your own research of the stock. Another insight is that the company has like an impeccable balance sheet. So it's got a bit of debt, but it's got way more cash. So any liabilities that become due, it has enough cash and liquid assets to pay off those loans. Another thing is that it has an incredible track record. So the company is very profitable, and it's been able to grow earnings by like almost 26% per year for the last 5 years. So had a really solid track record, and it seems like that will continue, but not at the same pace. So while it's got an impeccable track record, the future growth does look good, but not as good as previously. So like we can see there, the earnings growth is expected to be about 16% per year when it was about 27% per year. In regards to dividends, the company doesn't pay one, but it does have a buyback program. So it's currently, I think in 2021, it bought back about $1.9 billion worth of stock, and it's set to have a continuation of the buyback program. So that's how it's choosing to return capital to shareholders. Another thing to note is that there has been some insider transactions over the last couple of months. So there's about just under $3 million worth of stock bought from a few different insiders. And it's good to see, I believe they were members of the board, and it's good to see that these members of the board decided that during this recent pullback, it was worthwhile increasing their position in the stock, because they obviously, there's one reason you'd buy a stock, because you think it's going to go up. So it's good to see that they believe there was entry prices in this recent pullback that was worth taking advantage of. And you can see more details of that in the ownership section. So those are pretty much the findings from the report, and if that's enough to go off, that's great. But if you'd like to stick around now, I'm going to go through the whole report and show you how I found out those findings and what my insights are as I read through it. So for starters, as you probably know, I always start at the top of the report and have a look at the Snowflake. So like I mentioned, the company has like an excellent balance sheet, has a really solid track record, has pretty good future prospects, which we'll have a look into and see why the growth might be slowing down. Valuation seems good in a few metrics, but doesn't pass many, about 4 of them. So we'll have a look into that and see how it compares to its peers in the market that it's in. And as I said, Dividend doesn't pay one, so it doesn't pass any of those checks. So good summary there all around, and I'll get some more details in just a second. If you're not familiar with PayPal, it's like a digital payments company, and competing with the likes of Visa and MasterCard, and looking also to expand its presence in like the crypto space, and that's kind of, I think, what some people believe the growth drivers could be, as well as its core business having some organic growth as well. So we'll try and get some more insight into that as we read through the report. So having a look at the risks and rewards here, we can see that it's potentially trading at a discount to its fair value, or simply Wall Street's estimate of fair value, a discount of about 38%. So that's pretty interesting. We'll go and have a look at that in just a sec. Earnings are forecast to grow at about 6.04% according to analysts for the next couple of years per year. So that's an interesting takeaway. Not as fast as it has been previously, but still pretty good. And earnings grew by 57% over the past year. So it's had a very solid past 12 months leading up until the September 2021 period. As for the risks, there's only one, and it's that there is a large one-off item impacting the financial results. So that's interesting. That might give us some insight into this earnings growth of 57%. We'll go and have a look at that and see if we can learn any more, and what more research we might need to do to find out what that one-off item was. So next section I have a look at is the competitors, and basically just to get an idea of, if I'm looking at this digital payment space, is PayPal the best opportunity for me? So here we can see the competitors, the likes of MasterCard, Fiserv, I'm not sure how you pronounce it, Fidelity, and Square. And I think Visa obviously would be a competitor as well. So the thing that's really useful to do here is to have a look at these snowflakes and compare them to PayPal, right? So as part of my normal research process, I would obviously read through the whole PayPal report, and then to get an idea of the competitors, I would read through their reports as well. But for now, it's really useful to get an idea on these guys just by looking at their snowflakes. So we can see here that Fiserv and MasterCard don't seem to have good dividend prospects. So as you can see, they don't pass any of the checks. And MasterCard doesn't have the best balance sheet, has an okay track record, and has pretty good future prospects. Similar sort of story with this company here, except it's got better value prospects, not as good future, and a potentially a bit better past track record. As for Fidelity, it seems to have very good dividend strength, potentially good value, okay future prospects, and an okay balance sheet, but not a good track record. So that's interesting. And as for Square, it seems like the highest growth of them all. It has very good future prospects, or Block, I should say, sorry, has very good future prospects, okay track record, very good balance sheet, and okay valuation in that sense, but not good in the dividend sense. So depending on what kind of company you're looking for, or what kind of investment you're looking for, like if you want a dividend stock, then Fidelity might be more appealing to you. But if you're looking for the tech and like digital sort of space, you'd be looking at these kind of metrics here and paying more attention to them. So once I finish researching this, I'll go off and have a look at these companies as well. So the next section I have a look at is the price history and performance. And this is just to get an idea on what the share price has done based on different developments and how it's trended over time, based on those particular developments. So as you know, I don't make investments based on share price movement alone, because that's like speculating. Instead, you try and get an understanding of what's happening in the underlying business and how the market has reacted to that news. So one thing I would do, and I won't do it on this video, but I would read through this chart here and try and get an understanding of what's been happening in the business and what developments have been going on, right? So it's really useful to read through these just by themselves, right? And just seeing what is going on, like what new projects they're working on, what management has done, what like new announcements and stuff. Like for example, if we were to click this one, we can see they reported their earnings, so you can get more context on their earnings there. You can see that PayPal is looking to actually seek acquisitions, and there was a comment from their CEO and president. And then they provided guidance for their fourth quarter and full year results. So reading more of those details will be really useful. And then as we try and build our thesis around the stock and try and get a better understanding of it, or we can do that by reading all these, and that's how we get a better understanding of the business. So this is a really useful part to read, just to see what's going on and basically get up to speed on what's been happening in the business. So that's what I use this section for, and it's really, really quite handy. Same sort of story with this recent news and updates section here. So remember I was talking about the like crypto updates side of things, and it looks like PayPal is obviously looking to pursue that venture. And there was an article here written by some of the analysts in Simply Wall Street team, and it's covering that sort of news. Same thing with these articles here. Some of them are written by authors at Seeking Alpha, and just keep in mind that's obviously their opinion that they're sharing, but it's still analysis and worthwhile considering as you build your thesis. Now, one thing I would share is that if you've got a very bullish opinion on a stock, it's really good to try and counteract it and see where your bullish opinion might be wrong, right? To try and stress test your theory or your thesis. So say you're very optimistic on a stock, it's worthwhile trying to see why you could be wrong. And if there's articles and authors and analysts that are covering the stock and have a different opinion, very useful to read to try and see where you could be wrong. And you can find some articles here. And as for the other updates, it's just more about the underlying business and what's going on. President notifying of intention to sell stock. You can get updates on that and see if it's okay, right. So the total compensation is about 4% salary, 96% other compensation. So selling from the president seems to be like a predictable thing considering his compensation, and we'll get into that in just a second. So next section I'll have a look at is shareholder returns, and it doesn't look like PayPal has had the best year compared to the market, but then again the market has pulled back quite a bit recently. So it seems to have been a broader sell-off overall. So you can see here that PayPal has actually declined by about 22% over the last 12 months. And compared to the IT industry, that's much worse, right? US IT hasn't declined anywhere near as much, at about just over 3%. And the US market has actually gained 13.2%. So it's underperformed significantly. And one thing to keep in mind is just like why that sell-off might have been. Like, was it that PayPal was, optimism was really high 12 months ago and like it was priced to perfection, and now like expectations are a bit more realistic? Or is it like some news has come out that has really deteriorated the future prospects of the stock? That's just something to consider about like why it's deteriorated so much compared to the market, and has the market just had or what's driven the market up, right? Or what's more recently, because it was up about 30% and it's now only 13 over the past 12 months. Why is that so? So trying to get some context around these returns is something else I would do, just to see if it's like a problem specific to PayPal or the company I'm looking at, or if it's like a market-wide sentiment as well. And in this case, because the returns are so divergent and so different compared to the industry and market, it's worthwhile saying, okay, what's unique at PayPal that has driven it down so much compared to these comparables? So that's another step I'd do. Now, the next section would be just reading about the company, trying to get an understanding of the underlying business and see how it operates and what kind of businesses it has. You can see here PayPal has the payment solutions, including PayPal, PayPal Credit, Braintree, Venmo, Zoom, Hyperwallet, and iZettle products, and a whole bunch of others. So if you weren't too familiar with the business, you'd read through this section and even go to their website if you want and just get more understanding of how it operates. Because if you're trying to make an investment in a stock, is very important to actually understand the underlying business, which is like I mentioned that bit before, just to get more color on the company. And so you're not just speculating and investing off like a few data points. You want to know the underlying business so that you can then interpret and analyze developments as they occur. Say they go and release a new product, you can then understand how that impacts the core business or how that can help your thesis or detract from your thesis. And so knowing what's going on in the underlying business and knowing what they actually do and how they make money, how they spend money is very, very important. And this bit can help give a very basic understanding, and then you can go from there with the news and updates I mentioned above. So the next section I have a look at is the fundamental summary, and this section is really good just to get a high level overview of how the company is currently valued and like multiples it's currently trading at, and also how the company has a breakdown of its revenue and expenses. So I'll go into this now. So the company has a market cap of like 220 billion. So it's not a small company, but it's not the likes of Apple being a $3 trillion company. So with that, it generates revenue of about $24 billion and it has earnings of about just under $5 billion. So with those metrics there, it gives it a PE ratio of about 45 times earnings and a price to sales ratio of 9 times. So given that it's profitable, I'm not too interested in the price to sales ratio. If it was unprofitable, I would care about price to sales to then be able to compare it to its peers, but I can use price to earnings ratio here. So one thing to keep in mind is that looking at price to earnings ratio by itself doesn't give me much context. I need to go through the future growth section and have a look at how the price to earnings ratio compares to the expected earnings growth, and also how that price to earnings ratio compares to the industry and market that it's in, and how their earnings growth expectations compare. So like for the industry and market. So we'll get into that in just a second. And we even saw in the rewards section that the expected earnings growth is about 16%. So that gives me some context already, but I'll delve into that in just a second. So let's have a look at this earnings and revenue breakdown. Like I mentioned, it's just a very simple, very useful overview of how the company spends and makes money. So we can see here that to generate that $24 billion worth of revenue, the company actually has to actually spend $12.8 billion. And if I want to get more context on that, I can go to the company's annual report and just basically control find and go cost of revenue, and or some terms similar to that, and try and find where the company explains what its cost of revenue is. It could be like the particular teams that are related to the relate to building the platforms and the products that it has, because that's sometimes how these tech companies have their cost of revenue. It can be related to their data centers as well, because obviously they need data centers to run their business. Those kind of things can be included in their cost of revenue for a business like this. So that's where I would go to find out that information. Now, once it's spent that money to generate that revenue, that leaves with a gross profit of $11 billion and a gross margin of like 47%. So that's pretty good. And then once it's done that, it then has to spend money on the likes of sales and marketing. It doesn't have to, but it chooses to spend money on the likes of sales and marketing, research and development, and general and admin. And these are like employees' expenses in the non in the teams that aren't the ones we mentioned before. Sales and marketing budgets, research and development budgets, those kind of things. So all those expenses there add up to about $6.8 billion, and that leaves the company with a $4.9 billion profit, i.e. a net margin of about 20%, which is really good. Like, good to see. Like, it's not the highest margin out there, but it's a solid margin. It gives it plenty of leeway. So the last takeaway there is that the company has a debt to equity ratio of 40.5%. So pretty high. Like, it's acceptable, right? 40% is pretty good. But we can see that the company has a really good balance sheet. So I'll go and get more context, because it seems like it passes all these other checks. It has a really, it can afford this debt. But we'll get more context on that in a second. So the next section I have a look at is the valuation part. And basically we can see that it passes 2 of the 6 metrics that Simply Wall Street checks, and we'll go into them now. So according to Simply Wall Street's estimate of fair value, the company is trading at roughly a 38% discount. Now, that looks appealing at the start, and one thing to stress is that this is not a buy or sell recommendation, right? It's just an example of a fair value you can get to with particular inputs and assumptions. And so I look at this and I go, oh, okay, wow. According to Simply Wall Street estimate, which uses analyst estimates of free cash flow in the future and then extrapolates them out at a continuation of like a line of best fit, how is the company valued? And according to this, it's undervalued. So having a look at the data, if I want to go, I want to see how they got there, I can have a look at all the data here. And one thing I've talked about in other videos, but I'll stress again here, is that I can then go and build my own model. Like I can go online and go and get a discounted cash flow template from anywhere. There's plenty online. And I can go and input these same assumptions simply Wall Street has done, and then I can go and actually change them if I have a reason to believe the numbers could be different, right? So say I have a personal belief that I think the discount rate should be higher because interest rates are increasing or expected to increase. I might want to be a bit more conservative with my future estimates, and I go, 7% discount rate, or 8 or 9 or 10% discount rate, right? Like that's something I might want to change. And if I was to do that, that would give this company a very different valuation, because those future cash flows, if they're discounted back at a higher discount rate, they would be worth less today. Like it's the whole aspect of the time value of money. So that's one thing to keep in mind. And same thing with the perpetual growth rate. So that's how they got the perpetual growth rate. But for example, I may want to be even more conservative and go, no, I think it'll only grow at 1% into perpetuity. Or I may think, no, I think the digital payment space in terms of crypto and everything is going to be huge, and PayPal is going to be a beneficiary of that. I think 3%, for example. Like that's very optimistic, because 3% perpetually is huge. So that would have a big impact on the valuation as well. And yeah, just to stress, like you can go and do your own model and just change these assumptions and inputs as you see fit based on your own research. And so yeah, you can also get more color here on the free cash flow estimates from analysts and how we extrapolate them, and what their present value is if you discount them back at that discount rate that we saw above. So that's interesting to know. I'll keep that in mind, and then I will go and do more research, get more understanding of the underlying business, and then I might run my own DCF model and change the inputs as I see fit if I want to be more conservative, or I think if the model is too conservative. That's just some context as to how you can use this data. So according to the model, it's trading at a discount, and a pretty big discount at that. Now, this next part's very important, right? So the price to earnings ratio gives me context about how the company is trading compared to the industry and market that it's in. And according to the industry that's in, it's trading higher at 44 times earnings versus 36. And according to the market it's in, the US market, it's 17 versus 44. So overvalued compared to those comparables. So what I'm going to do though is I'm going to go to the future growth section in just a sec, and I'm going to get some context about how much earnings growth each of these particular areas are expected to have, so the company and the industry and the market, and we'll see if that kind of justifies why PayPal is trading at a premium. So price to earnings to growth, not too meaningful to me here. Price to book, not too meaningful to me here. So I'll go to the future growth section. So according to the analysts that cover the stock, all 45 of them, the company is expected to have annual earnings growth of about 16% per year. So that's pretty good. So we can get some more visual context of that here. Basically seeing from here to the left how the company has performed in the past and how the company is expected to perform in the future. Now, one thing to keep in mind is this is the average of the analyst estimates, right? Like, so there's some analysts that have higher expectations than this particular number, and some analysts that have lower expectations than these particular numbers we're seeing here. But this is the average, right? The consensus pretty much. And what it's important because then when we go and do our own research, we may have reason to believe, based on the research we've done, that we would change these numbers, right? So I may look at a few different projects they're working on and go, I think these are going to be huge revenue drivers, like say they enter the crypto space and really solidify their standing in that particular space, and their organic growth is much better because they're entering new markets and stuff like that, or they take market share, for example. I may think, I think revenue is actually going to be higher, therefore like that changes my particular model, which is all you can look into in the discounted cash flow model. So having a look at this, similar sort of story, right? Just understanding that this is the average, and these update as well. So as analysts change their models and they like the new, say for example, the company posts earnings and new data comes out, and the analysts interpret that data and then they change their models, this chart here could change. So this is a chart that's definitely worth checking regularly, especially the whole future growth section and the valuation section as well, because this chart is based off their estimates, and so as their estimates change, which is at least roughly once a quarter, potentially, you would check this chart again and just see how consensus estimates have changed depending on the most recent data. And with that in mind, you would also check the valuation section, because as new estimates come out from these analysts, that model above was also based on their estimates of free cash flow. So that model there could change. If they all of a sudden expected no growth in the future, that model would look very different because it would be based on their estimates and updated. So two things to keep in mind: checking the valuation and future growth section pretty regularly just to see how the estimates are going. So next section to have a look at here is going to give us more context to that P ratio we saw above, right? So here is the analyst future growth forecast, and this is for earnings and revenue. And as we saw, PayPal is trading at a PE multiple of 44 times, and the industry is trading at a multiple of 36 times. So it's interesting, right? Because they're expected to have roughly the same earnings growth, but it seems like investors are willing to pay a higher price for PayPal. And now you might have to look into why that is, right? So is it because PayPal is like such a dominant player in the space and like a well-known name and brand, and investors are just willing to pay a premium for that kind of established track record? Or is there some other reason? Because it's like, according to future estimates, they're both expected to have roughly the same earnings growth. So one takeaway here is that it's like, okay, say I wanted a company in the digital payment space, and I don't care who, or IT space, I should say. What I could do is I could go to the screener and I could filter for any company in the US IT space, and I can go filter for earnings growth above 16%. And what that would do is obviously it would filter out PayPal, and it would show me all the companies that have earnings growth expectations that are higher than that. If I was looking for a high growth stock, that's what I would do. And what I could also try and find is a company that may offer a better price to earnings and earnings growth ratio, right? So I may look and find an example in this industry where it's like a company trading at 30 or 36 times earnings, like we saw above, and is expected to have like higher earnings growth, because that would be a pretty good trade-off, right? Like a cheaper price for higher earnings growth, that's a really good sign. So that's one thing I can take away from here. And a useful tool to keep in mind that it's like, if this isn't maybe the best opportunity you're looking at, there might be better opportunities out there, and that's how you can go find them. So if we compare it to the market though, PayPal is expected to have a higher earnings growth in the market, so that might help explain why it's trading at such a premium, and that's a pretty obvious takeaway. But considering the premium is much higher than the market, like 44 versus 17 times earnings, that's something to keep in mind, where it's like, okay, is it deserving of that much of a premium? That's subjective and up to each analyst and investor to decide. And as for the annual revenue growth, it seems like PayPal is expected to grow its top line the most, right? So 16% versus 14% versus 9%. So maybe that's why it's trading at a bigger premium as well. Like, it's expected to have more revenue growth than them, so investors are willing to pay more for that. That's something to keep in mind. And we can see here, passes these checks, expected to grow, but not significantly, right? Not growing above 20% revenue or earnings. Revenue or earnings. Now, the next section here is the earnings per growth forecast section. Earnings per share growth forecast section, and you can see here that the blue line is basically the trailing earnings per share figure for the trailing 12 months, and this is what has happened. And just like the future growth above, we can see here that this teal blue line is the forecast for the future, and the teal shaded area is the expectations for the range of expectations. So the most optimistic earnings per share analyst estimate for the end of 2022, and the least optimistic. So we can see there's quite a divergence here in the short term. So there's some analysts who believe, or actually it seems like all analysts believe, that to the end of 2022, for the full year, the trailing 12 months, they all expect earnings per share to decline for a bit. So that's interesting, right? Like they clearly believe that there's some sort of reason why the earnings per share will decline over this trailing 12 months for a particular period, and that's something we can look into by looking at the company's guidance and like updates and what's kind of been happening. But as we get to the end of 2022, it seems like some are very optimistic and some aren't as much. So some really expect a lot of earnings growth to rebound and a lot of growth to occur, and some actually expect it to even get worse, right? So they say, yep, I think earnings per share are going to decline from where they are right now, and even more so by the end of next year, 2023. But that person, or I assume these analysts, then expect earnings per share all pretty much to go up and to the right by the year 2024. So while short term it's kind of range of estimates, longer term their estimates seem to kind of tighten a bit, and everyone seems to have a sort of consensus that it's like, yes, earnings per share will go up and to the right. What we can use this section for, or how it can help, is that, like I mentioned before, when you go and do your own qualitative research and get more understanding of the business, we can then come back to here and see what our particular estimates are, right? So say I look at the projects and I go, yep, I think these projects are really going to contribute to the bottom line. I may actually think that this top sort of line here of estimates, or like my own forecast, is around here, and I go, wow, I think earnings per share growth is going to be higher than everyone else expects. Therefore, I think today's price is pretty cheap, right? Because I don't think it's going to have 16% earnings growth. I think it's going to have like 18, 19, 20, 21% earnings growth over the next couple of years. So that might mean that I think today's price is a much more fair price to pay. Alternatively, I could look at those same projects that they're working on, and I may come to a different conclusion based on the research I've done. And I may go, no, I don't think they're going to grow as much as everyone else thinks. I think their earnings per share is actually going to decline for a bit, and not grow as much as everyone thinks. Like maybe 13, 12, 11, 10% per year. And if that's the case, I may look at the same price today that everyone else is looking at, and I may go, nah, I think that's too expensive because it's not going to have as much earnings growth as everyone expects. So that's how you can use this kind of section just to get some context, and then what you can do to try and come to your own conclusions based on your own forecast. So let's have a look at the future return on equity. This is basically just those analysts that provide an estimate of future return on equity. Basically, it's how profitably the company is expected to allocate shareholders' equity in 3 years' time, being shareholders' money. And it's good to see that it's expected to be at around 21%. Anything over 20 is really good, and it's going to be higher than the industry is allocating it right now. So it's good to see that there's expected to be plenty of profitable initiatives for the company to invest in at least 3 years' time. So that's good stuff. Now, let's have a look at the past performance. So like I said, it's had a really good track record, like 27% earnings growth for the past couple of years, and it passes a lot of Simply Wall Street's checks. So let's have a look at it. So we can see here that if we just look at the earnings and revenue, they've both been trending up and to the right, right? So back here, it's been pretty steady, but this last couple of years has really had a big impact on the company. So revenue's kind of picked up quite a bit as like digital payments have really kind of started to grow and have more traction. And it's interesting to have a look at a bit more specifics like the operating expenses. So having a look at this, we can see that the company has current profit margins of about 20%, but prior to that, it had 15.4%, like even here 13%, 13.8%. So in such a short period of time, it's been able to increase its profit margins quite significantly, and that's really good to see. But there's one thing we need to keep in mind. So this quality earnings check tells us if there's been any one-off items that aren't indicative of the company's core business, right? So we can see here that actually PayPal had a large one-off gain of about $1.1 billion impacting its September 30, 2021 financial results. So if we were to look at that, it's like, oh, well, if we take off that particular one-off item, the earnings might not be as high, or wouldn't be as high. So then the profit margin wouldn't be as high as well. And so that's something to keep in mind, because it's like, well, let's go. What we need to do is go and find out details about that one-off item. And I did a tiny bit of digging, and I seem to believe it's part of their strategic investment portfolio, where they made a particular gain on like part of that portfolio, and it's not expected to recur. So that's one thing to kind of consider as you look at these charts. Like, okay, we've warned that there is an issue with like one-off items that weren't expected to recur, which is kind of adds to the understanding of like why the earnings per share might decline over the next year, because like we saw, that was a one-off gain that helped the earnings per share, and then it's declined since it's expected to decline or normalize back again over the next couple of months. So that's interesting to see. And now one other thing I want to take away from here is having a look at the operating expenses. So this is stuff like the company's research and development, sales and marketing, general and admin, those kind of operating expenses that they need to keep the business running. And you can see here it's not growing as quickly as revenue, which is also what is probably helping the company's net profit margin grow. So one-off impact aside, if we were to look at this, we say, okay, operating expenses are growing, but revenue is growing quicker, therefore more money is flowing through to the bottom line. So even if we take off that one-off gain, it still seems like things are performing pretty well. So that's good to see. Now, having a look at the past earnings growth, it's been an amazing past year for the company, really outperformed market industry. And the past 5 years, the company's performed really well, because over the period of 5 years, that percentage difference of like 16 and 13% versus 26 really does start to add up, especially as you compound it. So great track record, really good to see. The company has plenty of profitable initiatives to invest in, so it's allocating shareholders' equity really well, generating a return of like 22%, and that's really good to see. Not only because it's above 20%, but also because it outpaces the industry as well. So it's one of those companies that is a top performer in its space. As for these two metrics, not too meaningful to me here, the return on assets side of things, especially because it's just like in line with the industry, so there's no huge takeaway there. And the company's return on capital employed, it's been sitting roughly at around 13%, and it has been for a couple of years. So not a huge takeaway, like it's total assets minus current liabilities, but it's like it would be good to see if that was higher, but considering where it is, it's not terrible, and it's not changing much either. So we'd like to see that moving up and trending upwards compared to where it was 3 years ago, but doesn't seem to be the case. So financial health, let's have a look at how the balance sheet performs. And as we saw from the track record, the health section, it seems to be PayPal performs really well. So this first check here compares short-term assets to long-term long-term liabilities, and short-term liabilities. And we can see here that the company has plenty of cash and cash equivalents to pay any liabilities that were to come due in the next 12 months, or any liabilities that are to come due in greater than 12 months' time. So that's really good to see. It's got a solid financial position there. As for the debt to equity history and analysis, good to see that PayPal's like retained earnings and shareholder value obviously has been growing up and to the right thanks to share price appreciation and growing earnings. So however, it's also been taking on some debt, and it's like we saw in the debt to equity ratio check at the very top, it was about 40.5%. And while that might be concerning, like it's like, okay, it's taken on a fair bit of leverage for its capital structure. Should we be concerned? If we consider cash as well, cash and equivalents, it's not a concern, right? Like the company has $9 billion in debt and $13.29 billion in cash. So it can easily pay off its debt if it needed to with the cash it has on hand. So in terms of a net debt to equity ratio, it's totally fine. Like the debt isn't too concerning. The company hasn't been reducing its debt, but in terms of all other metrics, in terms of can it afford the debt, yes, it can. And that's really good to see. Balance sheet health here. I won't have a look at these details just because it's like it's reassuring to see the company has such a good balance sheet. But if it was a bit concerning, I'd try and have a look at more details here. Now, have a look at the dividend. The company doesn't pay one, but like I said, it does have a buyback program going on. So it's electing to like reinvest in itself and return money to shareholders in the form of buyback, but it's not paying a dividend. So what I can do here to get more context is to go and have a look at the buyback, see how much of the stock they're buying back, and see like if they have a particular price cap at what price they're willing to pay for the stock, or if they're just buying in general. So they typically have buyback programs that run for like a couple of years, just companies in general, if they start one. And it'll be good to see how much buyback is remaining, and how much money they've allocated to buybacks as a portion of their free cash flow. Because if they're allocating like almost all of their free cash flow to doing buybacks, basically it tells me that they're not reinvesting that much in the business. But if they're allocating like 50, 40, 30% of their free cash flow to buybacks, that tells me that they're retaining plenty of it to then like reinvest in themselves. So that's good to see. That would be good to see. And I'll try and get more context on that after this video. So having a look at the management section, we can see that the average tenure is about 2.6 years. So that's pretty good. Like it's not a high turnover. If it was less than 1 year, I'd be really concerned. But it's not. It's 2.6. That's great to see. Having a look at the CEO, he's been there for about 6.5 years, which is really good to see. And he's compensated $23 million. So let's try and get some context on that. Oh, and also, if I wanted to learn more about him, I would read this section here just to see what his experience is, where he's come from, and what he's done. And I'll probably do that after this video. So to get some more context on his compensation, we basically just want to see that he has been compensated in alignment with the company's underlying earnings. And we can see he has a consistent salary of about $1 million per year, and considering he's running a $220 billion company, that's pretty standard. But his total compensation, which is the stuff that includes like stock compensation and everything like that, has grown. And you can see here back from 2015, it's grown considerably to, or if that's probably when about he started 6.5 years ago, it's grown considerably and had a really solid year here in 2019. So it's good to see though, basically the summary is that his payment or his compensation has been in alignment with company performance, since company performance is going up and to the right, and his payments been going up and to the right. However, for companies of a similar size, he is paid above average. So $11 million versus 23. Something to keep in mind. It's up to us as investors to then decide if we think that's fair or if it's overcompensated based on like what we see competitors are paying their CEOs, and if we think it's like justified. So having a look at the next section, we can see the leadership team. And basically I would read through all the profiles here and get an idea of actually who's running the shop. Like who are these people? Where have they been? Just like I mentioned with the CEO, seeing their tenure, it seems like they've all been here for at least a couple of years. Some are newer than others. And in terms of their ownership, let's see if they're aligned. So $35 million with the CEO or the president, 20 million, 3.6, 7.3, 925, 6.4, 11, and then no data for the others. So that's pretty good alignment. Good to see, like, for those that we do have data on, it's good to see that they've got a fair bit of money invested in the stock. But you may want to see that they're increasing their position, right? But for the most part, considering the amount of time that they've been in the company and the amount of money that's invested in it, from my point of view, I think that's pretty okay. Now, like I mentioned, average tenure is 2.6 years, and that's pretty good, not a high turnover. So having a look at the board members, I would do the exact same. Have a read through each of these profiles of the particular board members and see just where they've been and what their experience is and like what they bring to the table. As for their tenure, it seems much longer, right? So they've got an average tenure of about 6.5 years, and for the most part, we have a lot more data on them. So we can see here that 35, 3.9, 4.5, 6.9, 12, 3, 3, 3, 2.5, like they've all got a fair bit of money. Most of them have got a fair bit of money invested in this stock, and it's good to see because that basically creates alignment with shareholders. Now, that provides some context to what we were about to see in the ownership section. So we can see here that there's been some insiders buying stock, and it's like, okay, interesting. Let's see who it was. So in the past 3 months, there's been a lot of buying, and it seems to be from these insiders. So these members are chairman of the board, member of the board, director, independent director. So these particular board members have been buying stock, and we can see what the prices were that they were paying for the stock. And it's interesting because basically it tells us that, okay, they figured that the recent share price decline has been enough to justify increasing their positions. So they've bought some stock, and it's really good to see because you buy a stock for one reason, that you think it's going to go up, and it's good to see that they basically think there is potential value there. It's not a strong signal, but it's like a signal enough that it's like, okay, there was enough reason for these insiders to buy, and that can be something we can look into further. Like, okay, there's insider support. That's good to see. Same as for the sale, though, it happened like 6 to 9 months ago, and that was almost at the high, so it might be worth seeing if there's any particular situation here. And we can do that by just looking at the SEC filings and looking at the particular transaction details of those particular trades and seeing if there was any reason for it, like if it was part of their compensation or if it was like a performance right that they're exercising, something like that. So we can get more context on why these insiders were selling by looking at that particular data. As for the ownership breakdown, looks like institutions own about 80% of the stock, which is huge. But this is the likes of Vanguard and BlackRock and those kind of entities. So plenty of shareholders own it because the company is so big, and there's plenty of passive investment vehicles that invest in the likes of the Nasdaq, the tech space, and the US market as a whole. So that's how these institutions own so much through their vehicles and investors buying those vehicles. General public owns about 19% of the stock, and then individual insiders don't have much ownership. So it's not really a founder-run business anymore. So you're not going to see like one individual with like 10% ownership, but it would be good to see more insider ownership considering like how big the company is. It'd be great to see that like a bit higher. And good to see that shareholders haven't been diluted in the past year. So they've actually had their share slice of the pie increase thanks to this buyback program that's going on. Shareholders who have been holding on, their slice of the pie or slice of earnings has been increasing because this company has been buying back stock, so reducing the amount of slices, which is really good to see. And now the last thing I'm going to have a look at here is basically just a breakdown of the shareholders. And what I would look for is if there's any big change in these shareholders' holdings. So having a look at the biggest shareholders, we can see that there's no particular individual, like we saw, no one with any particular power, but lots of institutions. And so what I would have a look at here is to see if there's any changes. And for the most part, there's nothing really like above 5 or 10%. Okay, UBS has been increasing their position quite a bit in the past 2 reporting periods. But yeah, like there's no large trend of many top shareholders like either adding up on their position and loading up on stock or selling off on stock. So no huge takeaway here, but that's what I would keep an eye out for. So that's pretty much the end of the report. As I mentioned at the start, the takeaways is like the company is in the digital payment space and it's looking to expand its sort of reach. Now, the summary is that like it could be trading at a discount based on simply Wall Street's estimate of free cash flow. But what I would reinforce with that is obviously as we go and do more research after this and try and get more context and understanding of the company's potential in the future, I would then go and run my own model and change the inputs and assumptions based on what I see fit to see what to then end up obviously seeing what I think a fair price would be to pay for the stock. Another takeaway is that earnings like have grown heaps over the past 5 years, but they're not expected to grow as much over the next 5 or next 3, I think, and that might be because they're expected to increase their expenses. But again, I'll go and do some more research and see what kind of investments they're going to make over the next couple of years. So I'm going to go have a look at the company's like underlying business. I'm going to go read through that recent news and updates, the price performance chart where I talked about all the recent updates that have been happening and like what projects they're working on. I'm going to go have a look at the competitors, read through all of their particular reports, see if there's any better opportunities out there, and also just go and have a look at like the industry as a whole. And specifically the risk I'm going to have a look at is that large one-off item, see what that was. Like I think I mentioned it was strategic investment portfolio gains, I'm going to go have a look at what that was. And like, I know it's not expected to be repeated, but like if this is something that we can expect multiple times over the course of the coming years, because that can be placed into my model as well. So I'm going to add this stock to my watch list based on the fact that I'm interested in the stock, and I'm going to start receiving updates on it from Simply Wall Street on my dashboard and in my inbox in the form of those important updates. So that'll help me stay up to date with the stock as I continue to do more research. So that's pretty much the overview of PayPal. I hope this video has been helpful. Thank you so much for watching, and I'll see you next time.